The only thing that differentiates profitable traders and non-profitable traders is simply risk management. So when it comes to trading, most people, they have profitable strategy, they are good at trading, they are good at almost every aspect of trading, but then they lack at risk management, and this has led them to actually lose more than the profit they've made from trading in general. So to help you save from that and help you avoid this risk of actually losing out on your funds despite having a profitable strategy, in today's video I'm going to share with you 5 things that you should actually do if you want to stay profitable in forex trading. These are 5 key risk management techniques that you need to apply in every single trade you take to make sure that you are always on the profitable path, even though trading is not always profitable. So without already said, hello guys, welcome to my channel and welcome to Perez Trade. On this channel, I mainly focus on how you and I can actually make money through trading crypto, forex, and stocks. So if you are someone who loves trading and then you want to get more information about trading, then I advise you smash on that subscribe button and also use the link that will be available in this video description to join my Telegram channel. So that already said, without taking much of your time, let's get straight to today's video. Let me share with you these 5 key risk management techniques that you need to implement in every single trade you take to make sure that you are profitable. So the first point here is simply accept the risk. So what do I mean by you should accept the risk? So when it comes to the trading, before you even start trading, the first thing you need to do is that accept the fact that you are taking a risk, because trading is a risk and it's a 50-50 game. So for you to be able to trade that sort of market profitably and have a clear risk management plan, the first thing you need to know is that you are taking a risk when you are entering the market. So a lot of people enter the market with so much emotions by not accepting the risk that will be involved in it. So before you even place your first trade in the market, one thing I advise you to do is that accept the risk that this trade you are placing is highly risky and it might not come into your zone to make you profitable. So when you're able to accept this sort of fate before placing an order, you have a high tolerance of risks. This will actually help you to see more profitable trade than losing trade, because when you accept something before doing it, it simply means that you are getting rid of your emotions. And to get rid of your emotion, that's why you need to accept the fate of whatever game you are playing. So for example, if I wanted to trade right now and I wanted to place an order, the first thing I'll tell myself is that once I'm entering this market, there's no more going back in it. So once I enter my market, I don't look into my charts that much again. Like, I just give it that free road to actually move. And for you to be able to manage your risks carefully, this is the first thing you actually need to do. Is simply accepting the risks before entering the market. This one will lower your temper and how you react to the market movement. So now let's move to the other 4 tips on how you can actually manage risks wisely. So the point number 2 is simply take advantage of stop loss and take profit. So you accept the risk that the trade you are taking is risky. Doesn't mean you should put the whole of your account in one single trade. So stop loss and take profit are very important things that you should consider before you place your trade. Like, before you place any trade, first of all, understand where your take profit and your stop loss will be. If you don't get these sort of areas on your chart, then the best thing is to avoid that sort of trade. So the point number 1 said, okay, accept your risks before you place an order. So you said that, okay, I've accepted my risks and I'm risking the whole of my account in one single trade. That's totally wrong. Even if you are using just a $10 account, which is a $10 or £10 account, you still have to lower the amount you are going to risk in a single trade to make sure that you still have more opportunity to actually trade. So when it comes into trade, the most important thing is actually preserving your initial capital. And the only way you can do this is by understanding risk management, by implementing these things that I'm sharing with you, which is the first one which says that accept your risks, and then this second one which says that take advantage of stop loss and take profit. Because when you have a stop loss set in your chart, it simply lowers the amount you are going to lose in a single market, because once the market hits your stop loss level, you automatically get out of the market, and that one just saves the rest of your account balance. But then when you don't have a stop loss, the market can keep going against you until your whole account get liquidated. Even some broker will still let it go and they give you a negative balance. So to make sure that you don't have this sort of negative balance in your account, I will advise you to put stop loss in every single trade you take. And then on the other hand, also said take profits. So what do I mean by take profit? Take profit are simply points whereby when the market gets to that point, the system will automatically close the trade and then give you that particular profit as the amount you've made from that particular trade you took. And then the benefit of take profit is that the market might get to a place whereby it has made you a decent profit when you consider how much you were risking for it. And then when you don't have a take profit at that very point, the market might reverse against you again. But then when you have a take profit set at that level, once the market hits there, the system automatically gets you out. And then this one saves you from any form of reversal that might go against you again. So that is the second one on my list, which is actually take advantage of take profit, stop loss and take profit to minimize your loss and also help you stay more profitable. But then what will actually make up a good stop loss and take profit? Well, that's where we'll get to the point number 3, which I'll be talking about another important thing you need to consider before placing an order. The point number 3 is simply maintain a consistent risk to reward ratio. So what I mean by risk to reward ratio is simply having a consistent amount that, okay, for every single trade you are going to take, you'll be risking this percent of your account to make this percent. So for example, one thing I normally do is that before I take any trade, I make sure that I'm getting either a 1:5 risk to reward ratio or a 1:2 risk to reward ratio. So I always look out for this. So until I get either of this, I'm not going to take the trade. And whenever I'm taking 1:5 risk to reward ratio, it must be a trade that is going to close within a few minutes to an hour time. That would be a very short trade. But when I'm taking a trade I'm really going to hold for maybe 2, 3, 4 hours, then I go for a 1:5, a 1:2 risk to reward ratio, because the longer I hold the trade, the longer the profit target I actually get. So before you place any sort of order or before you even start trading a real account, one thing I advise to do is to have a consistent risk to reward ratio, and then make sure that you abide by it for every single trade you are taking. So for example, if you are risking just a 5% of your account per trade, make sure that you keep this thing consistent, because the bigger your account becomes, the bigger that 5% you are risking. So you simply have to maintain this 5% risk ratio across all your trade. The reason why you need this is that if you are consistent with this, simply means that your profit will always be ×2 of that. Not because you were able to flip your account over then start using 10% risk to reward, 10% risk ratio of your account. No, if you do this, it will easily get you liquidated, because when it comes to trading, always remember that it's not by the profit you made. Even though we are all here for business, it's not always about the profit you made. It's by how long you stay in the market, because the longer you become, the more experienced you become, and then the more opportunities you actually see to make money from the market. So that is it about the third point. Is simply have a consistent risk to reward ratio per trade, and then keep this thing consistent and always focus on it before taking any of your trades. So if you don't get any sort of market that actually matches that level, you don't have to take the trade until you get a set that actually fits into that risk to reward ratio. Yes, you have no connection with placing any order in that sort of market. That's why I'll take fewer trade, because I always look out for higher probability trade to get my maximum risk to reward ratio. In case I don't see any, I don't place the trade. That's why I place only a few trade week in, week out. So with that already said, let's move on to the fourth point on our list. And if you watch this video to this extent, I believe you've already smashed on that subscribe button, like this video, and probably tell me what you feel down in the comment section. So with that already said, let's move on to the next. The point number 4 here is simply use a position size calculator to actually calculate every position you are taking to know the upfront amount you are going to risk for that particular trade. So what I mean by position sizing is that there are websites whereby you can simply put in your account balance, how much you want to risk, and how much you want to make out of that market, and then these systems will automatically give you every single information you need to place that sort of order. So with that, I'm going to take you straight on my computer and then show you how you can actually do that right on the internet. So you don't have to download any mobile application. All you simply have to do is a free website where that can actually help you do that. So for that, let's get straight on my computer. Let me show you how you can calculate your position size for free on the internet. So hello guys, now let me show you how you can actually calculate your position size to make sure that you are doing the right thing when entering the market. So for that, simply come over to Google and then search for position size calculator. However, there are two websites that I'm going to share with you, but you can simply come over to Google and search for position size calculator and use either of these two. So let's use this first one here, which is my FS book position size calculator. So for this, the first thing you do is that you come over here and then you pick your particular pair. So for me, let me say I'm trading Euro USD, and then my account size is, let me say, a gram, which is $1,000, and then ratio I'm going to put 1%. So let me say, because this one I want to risk 1% of my account to actually execute this sort of trade. So in case you don't understand what 1% of your total account balance might be, the easiest thing to do is simply swap it over to money. So from here, let me say I'm risking just $10, and then my stop loss pip, I'll just put 25 pips. And after that, you see where it says trade lot size, simply leave it as default and then hit on calculate. Now it's going to give you the right, you can see risk ratio 1%. So if I'm risking $10 out of $10,000, that simply means that I'm risking 1% of the account. And then unit, I'm buying a 4,000 unit of this particular pair that I'll be trading, and then my lot size here will be 0.04. So when you use this lot size of 0.04, it simply means that at the stage of 25 pip, that's when you're going to lose your $10. So this one simply helps you understand your position size easily. And then on that website you can also use is known as this one called buy pips position size calculator. It's another great website. So for this, you can come over here and pick your account. So by default, I know your account will be US dollar. So from here, you enter your account balance. So for example, let me say my account balance is 1,700. And then my risk percentage is still on 1%. My stop loss is still on the usual 25 pips. And then I'll come over here and choose the pairs. And I'm still going to go with the Euro USD and then just hit on calculate. Okay, so I mistakenly entered 0% here, so 1%. So after that, I'm going to hit on calculate. So now I can select it as calculate and show that at the point of 1%, I will be losing 17 USD, which is 1% of 1,700. And then my position size is actually 6,800 units of Euro USD that I'll be buying, which means that the lot size I'll be using is 0.068. So you can ignore this mini lot and micro lot that are below here. Simply focus on this upper side of it, which says that I'll be rating 0.068 in this particular market. So this would be my lot size. So this is simply how you calculate your position, and the benefit of it is that it lets you enter the market at the right point and know what exactly you are risking and what you'll be getting in return. So hello guys. Now the point number 5, which is the final point, is simply backtest with every single information before you apply it to a real account. So even if you are a pro trader and then you get a new idea you want to implement with your trading system, one thing I advise you to do is that first of all, backtest it with you can use for testing with a demo account, or probably use TradingView or Go Charting to actually do a backtesting period with it before you actually apply it to your real account. This is for safety reasons. So with that already said, hello guys, hope you find this video helpful. And if you do so, don't forget to smash that subscribe button, like this video, and tell me what you feel down in the comment section. So with that already said, have a nice day. Bye.